money. Okay, and I'll just use in my example, the cap you have is $7 million. Those notes would convert actually at 10% of that number because that's the valuation of your Series A. If your cap was $10 million, you would still convert at the lower of that 10% off the Series A price. And so your discount is a pretty important factor to investors. And generally they range between 10 and 30%. I always find that if you're closer, if you've got lots of traction and you're closer to a real round, the discount is smaller. But obviously the earlier stage you are, your team is not settled, you don't have a product, you're going to see a bigger discount. Just, it makes sense. Higher risk, bigger discount. Now, what people sometimes do, when we sort of got into this about the tranching of notes, you may offer, if you have a legitimate reason, certain investors a different discount, but you do have disclosures with that. And you cannot offer securities and tell somebody this is the deal and then give somebody a side deal. You'll need to disclose that. One thing that we often do, not often, but we sometimes see, is if you have an investor that wants better terms, what are you going to do? So you've already got some notes sold, and you've got an investor that wants a slightly better deal. It's hard, right? So you can either get consent, amend the other documents so people are treated equally. Because we haven't talked about it in our term, we often see what we call the most favored nations clause in there. So one thing that we sometimes see and do is if that investor can be an advisor, if he has other connections, if he can add value outside of the money, you may want to consider adding that investor on your advisory board. And I've seen that for numbers of investors who, I need to get Mitch Kapoor on my board. I've got to have him in. You may be willing to bring him as an advisor or whatever he would do on top of that, which would probably be well worth that added money. Go ahead.
Is there any expectation that if you're made an advisor during an angel round, that at some future round you'll be actually on the board of directors of the company?
No, I don't think so. I think the whole board seat's a whole separate discussion. And you should, if the board seat comes up, it should be talked about up front. Generally, my experience is an angel investor who's only putting in a couple $100,000 should not expect to survive to the board after a venture round unless they have domain expertise or is going to really put more money in. You'd want to have that discussion because if you think about it, if you're a fast-growing startup and somebody puts in $100,000 or $200,000 of your first money, can they really expect to be on the board when you're raising, $10, $20 million rounds of financing? So it's just one that you have a discussion with. But if the person adds a lot of domain expertise or other expertise, then they can stay. They'll stay on just because of that other expertise. But if you're just taking somebody's money, go ahead.
Does the discount still apply if the cap is lower than Series
A? You will take the lowest one. So if the cap is lower than 10% of the Series A discount, the discount goes away. Warrants. Everybody know what a warrant is? Like an option, a stock option. We don't see those really anymore. It's just not market. If you look at any of our term sheets 10 years ago, there was no discounts. It was all warrants. But today, it's just not market. From an entrepreneur's perspective, the warrant is better. From the investor's perspective, the discount's better. I'm going to try to keep moving on because we don't have much time. Conversion trigger. So this number is important. Not usually negotiated, but you just need to understand what it means. So we've been talking about these notes converting into equity. So if you have a conversion trigger, it's the number that the notes must convert into equity. Investors want to make sure that when you do your equity round, it's a real round. They don't want Nick to talk to his brother Christian and say, listen, let's get a really high valuation and convert all these notes. We'll do it at the highest cap or, at a high number. And you put in $50,000 in cost of conversion. Investors would not be happy with that. So generally what we see is about a $2 million trigger that the notes would convert into your Series A or Series C, whatever you're doing. And at that time you raise that money, the notes automatically convert. If you don't have that much money, I've got deals where, for whatever reason, we want to clean up our cap table. Things haven't gone as well as the company wanted. We've got all these notes out there. We want to convert the notes into equity. We will have to get usually a majority of the note holders to consent to that conversion. But for automatic conversion, you have to meet this trigger. Interest rates. I guess a couple things. First question to people is, do you have to have an interest rate? And you need to have an interest rate. It can be very low. It has to be at least the federal funds rate, which is one or two, very low, like less than 1%. It can be a very small number. Generally, you see 8%. The two things I always advise clients is one, keep it simple. Don't do a floating rate or a LIBOR rate. Just keep a nice simple rate. I've not seen investors really caring about the interest rate. It's just not a factor in their investment. But companies should realize, though, this is additional equity you're going to give up at the conversion. So in my example, where somebody put in $100,000, and we'll just make the math easy for me, you have a 10% interest, and it takes you 1 year to do your Series A. That note would convert, instead of $100,000, to be $110,000. So they would have, beside the cap and the discount, they get the extra $10,000 of interest converted, which you would not do in a Series Seed round, right? In a Series Seed or an equity round, there's no interest, so there's no additional shares there. A question?
Okay, this relates, I think, potentially to both the last 2 points. Suppose you're doing extremely well. You have lots of revenue. You don't need to do a series, an additional round of capital raising. Can you merely allow the note to mature and start paying it back?
I love you. You're great. You must be an entrepreneur. Wouldn't that be great? You get a early stage loan that's really equity, and then you don't have to pay that back to the person, the equity, when it's really valuable. Where's my investors? Would you do that deal? Sophisticated investor will not allow you to prepay or repay the note even on maturity.
So what's that term called within, what should we look for?
Well, it's prepayment is a key term in the note term sheet. Generally what happens in the note documents is when the notes, we're going to talk about maturity, perfect. So we'll talk about maturity and what happens. So generally, notes will have a maturity between 1 and 2 years. And two things on maturity. We have some investors here, so maybe they're familiar with this. If you have an investor or a fund who routinely invests in convertible notes, they're going to probably insist on 1 year. And that deals with some lender licenses rules in California. That basically there's an exemption from the registering as a lender if you invest or make loans to operating companies with 1 year maturity dates or less. If you don't have that type of investor, then you can do more than 1 year. Obviously, entrepreneurs, you want the longest period of time because you don't have a hammer at the top of your head like what's going to happen. But usually between 1 and 2 years is what I see. And if I'm representing an entrepreneur, I want to start off usually in 2 years.
You normally have converted value. It seems to run up, let's say, if you haven't raised, 1 year hits, here's what you convert at.
So we're talking about next bullet point. That's perfect. So what happens at maturity? So we've got the entrepreneurs like, if you're doing well, can we just pay them back? And they get just their money back plus this 8% interest. Sounds like a great deal. Some entrepreneurs say, well, can I just convert them? And then the price is, what's the price and what do they convert into? Entrepreneurs sometimes want them to convert into common at the cap valuation. Most investors will not be happy if you convert their note into common. So generally what I see is a couple things. One is you don't have a right to pay off the note. So the note stays there unless the note holders demand. If there's a written demand, and generally by the majority of the note holders, so you don't have Nick making a demand but not Christian, so you have to get a majority of the note holders to make that demand, then you can pay them. But most investors aren't going to make that demand, unless there's something else going on. The second would be the note holders would have an option to convert. And generally, when I represent entrepreneurs, I don't want them to convert into preferred stock because we don't have preferred stock, and it's going to cost a lot of money to convert them into preferred stock. And generally, if you've come to your maturity date and you haven't raised your next round, things may not be going well. Sorry about that. Things may not be going well. So generally, we would try to say that, well, if the note holders really want to convert, they can convert to common at that cap valuation. But that can be negotiated that you'd have to convert into a Series C on customary terms. What really happens is the notes just sit there. In reality is the notes just sit there and keep accruing interest. That's what, I think I mentioned up front. I had one time where we had a strategic investor who had a security interest who said, notes due, you didn't raise your round, we're going to take over the company. But that's generally what happens. What happens if you sell the company, which is this is more likely, and you haven't raised your Series A? So you're bumping around and you're going to sell the business and you've not converted it. So generally what we see is that the notes holders would have the right to receive higher of their money back, and usually a multiple. If you're going to like 500 startups, they'll want 2x, or at least 1/2x. Usually I see 2x. Or what they would receive if the notes were converted into common at that cap valuation. So if we give my example, if you have a cap at $5 million, and the note holders have a 2x return, they'll take that 2x return unless you sell the business more than $10 million, right? If you sell the company for $20 million, they'd rather convert because it's going to be higher return than the double their money back, which is a 2x. Did I lose anybody on that? Okay. All right. So that is one of the key terms you'll see. Some entrepreneurs ask, well, do I have to pay it back personally? Generally, no. I mean, generally, it's a non-recourse loan to the company. Now, if you go steal the money, if you could have exposure there if you act badly, but generally, it's a company obligation, not a personal obligation. The asking for a guarantee is just not market. I'm not seeing guarantees. Pro rata rights, that's one that's negotiated. I'm talking about a right to participate in the next round. Generally, you wouldn't give that right to somebody giving you $5,000 or $10,000 or $30,000, but if somebody's going to give you a big investment, they'll want a right to participate in the next financing. Protective provisions. Is there a clock up here? Just want to know what time it is. Okay, I'm going to have to really speed up. Protective provisions, I mentioned up front, these are the negative covenants, fairly unusual. You may see a request. You can't sell the business without their approval. You can't change the business without their approval. There may be a few additional negative covenants requested. But generally, with the note offering, there's very few, if any, protective provisions. Information rights, Board C. Again, if you look at the forms, our form, we don't provide necessarily information rights. So it's usually some investor in a side letter that will give information rights. Now, my advice to clients is you should be communicating with your investors on a routine basis. Investors, if things don't go well, and you have to raise more money, most likely the people who put in initial money will be where you're gonna have to go. Because they're already in. So I always, recommend, maybe a quarterly update. Sometimes you'll want more than that, but, quarterly, email, this is what's going on with the company, that type of information. And if an investor is really desperate for more information, I wouldn't necessarily not do that. I would be not afraid of showing what's going on. Board seat, we talked about that a little bit. Very unusual to see convertible note holders go into the board unless it's a sizable investment. And then I would have that discussion of what happens when you get to the Series A and make sure that expectation is discussed about. We see, at least I see more observer rights for the board.